Now, there are three major markets worldwide. These are Asia, UK, and New York. And outside of these, there are minor markets like Australia, Frankfurt, etc. But these are the major ones with the most capital, and therefore this is where we are able to identify that each of these three sessions have a typical behavior and where the majority of the price action will happen. These bots that you just learned about play in all of these markets. In Asia, more than 70% of orders on the Tokyo Stock Exchange are made by AI bots. In India, which is a market that falls under the Asia section, the estimate is roughly about 40%. In Europe as a whole, in 2009, studies suggested that EU AI trading accounted for 60 to 73% of all equity trading volume, and the recent estimate is around 80%. The US have been using AI bots to trade since early 2000, and that accounts for about 70 to 80% of all US volume. So you can see here that a lot of what you're seeing that happens on the charts is not even happening by humans, and it might sound scary, but the thing that is actually an advantage is if you can learn what the bots are actually looking for, then you can just do the same thing they do. And that's why this method focuses heavily on where people's open positions are, where is their liquidation level, because the liquidation level is what these bots are hunting for. And that right there is why this method places such a heavy emphasis on knowing where these levels are. So now that you know who your opponent is and you understand that they use AI to get an advantage over retail, we now need to understand what their actual objectives are, because by understanding this, we can then know what they're capable of doing. Before we delve into how the market makers move the market, it's critical to understand their objectives. If you can start each of your charting sessions by assessing their objective based on the price action, it will give you a head start on whatever else you're looking for that day. The market maker only has 3 objectives, and it's really important that you ingrain these objectives into your head. Write it on a piece of paper, stick it on the wall where you trade, laminate it, screenshot this, whatever you need to do. You need to keep these 3 objectives on hand at all times, because it's going to help you to understand the moves that they're making when you see them on a chart. The market maker's first objective is to induce retail to take a position. They induce you to do that by driving prices out of a range. So when you look at the chart every day, you want to check to see if price looks like it's consolidating or it's stuck between a support and resistance level, and basically it's just going sideways. If that is what is happening, then the market maker is building their own positions whilst getting ready to move price swiftly out of the range, as that will induce retail to take a position. When that happens, all we have to do is wait for them to drive price out of that range, which will signal the beginning of their move. There are ways that we can be part of that initial move for a better entry, and you're going to learn that in this course. Objective number 2 is to create panic and fear. If you've traded before, ask yourself, have you ever waited for a particular level to break out, but price just kept going sideways in a range, leaving you waiting for hours or even days for the breakout? And then after such a long time waiting, all of a sudden a huge candle appears out of nowhere and you're left thinking, damn it, I missed it. This is done by design. A very large green candle breaking out to the upside or a very large red candle breaking down to the downside is all part of the objective, which is to create panic and fear. So if you've ever found yourself waiting for, say, a symmetrical triangle breakout, for example, for days, and then the breakout happens unexpectedly, it causes you to think irrationally and just jump in at the end of that candle because you waited so long for it that now you don't want to miss the trade. And because you convinced yourself that the move is going to be really large, you decide, well, I better just get in now, because what if there is no pullback? This is all done on purpose. When you're in a state of panic, you're unable to think clearly. You begin to entertain possibilities such as perhaps it won't come back for a retest, or perhaps I should just jump in now. And this results in you making a silly decision, which leads to you now being in an open trade with a bad entry, and now you're committed to that trade, and that trade has a liquidation level or a stop loss, and that will become the market maker's future profit. So that's why they intentionally create that panic and fear, to make you think irrationally. Because remember, as I said before, all the market maker needs is for you to commit to a position, which brings me to objective number 3. And objective number 3 is to hit your stop losses and pocket your money. Stop losses are the liquidity for the market maker. Market makers simply can't enter a large position in the order books in the same way we do as retail traders. As a retail trader, we can just go onto an exchange, enter the price that we want to enter a trade at, put in our stop loss and our take profit, and decide how much we want to put on that trade, and then just hit buy or sell and wait for it to be filled. But because the market maker trades with such great size, they don't have this same option. If they were to put in a limit order at one price, they would create such a large buy or sell wall, number one, but also they wouldn't be able to get their whole position filled because retail is the other side of their trade, and retail can't meet the demands of the market maker at one price. If they did a market order entry instead, that position would move the market so much that they would end up with a terrible averaged entry. So their only choice in order to get all their positions filled before allowing the price to take off is to hit our stop losses and our liquidations. Because your stop loss or your liquidation is just an order in the opposite direction. Meaning if you were in a long position That entry is a buy order, but your stop loss on that order is a sell or a short position. So the market maker is just meeting the other side of that trade, the trade that takes you out of the market in a loss. In order for the market maker's positions to get filled, the market maker really has no choice but to send price into an area where they know a lot of people will have stop losses. The market makers can't trade the same side as you, because if you're buying, they have to be selling. And if you're selling, they have to be buying. Because for every buyer, there has to be a seller and vice versa. So if everybody was buying, then nobody would be selling, which means price cannot move. So whenever the price is moving up, we buy as retail traders because that's what we're taught. But the market maker is actually selling to us. And their selling to us is what allows us to buy. So with all of that in mind, a stop loss is simply a buy or sell order in the opposite direction to the trade that you're in. The market maker knows that when you have FOMO, which means fear of missing out, you will eventually make a poor decision, which leads you to engage in a bad trade. As a result, your stop loss generates the liquidity for the market maker. And once their positions are filled, you've been stopped out or liquidated, then they send the market in the opposite direction. Nonetheless, none of this should scare you off trying to trade. We only need to know and understand what they're doing, because if we know and understand what they're doing, we can be on the right side of it. We can wait for the stop hunt to be issued before we enter a trade, for example. We can anticipate that it's coming soon because we understand the market maker's behavior. If you have traded before and you find that you often get stopped out on trades, this is because you don't understand the market maker's behavior. But don't worry, because you're now here, and by the end of this course, you're going to fully understand what they're up to. Just know that this isn't some sort of genius strategy that you're learning right now. It's not necessarily the answer to everything that's been going wrong for you thus far. This strategy is derived from Forex and other trading markets with market caps in the trillions of dollars. Sometimes people will say to me, Annie, what happens if a lot of retail learn this method? Will they then change it? But what you need to understand is that this has been happening in Forex forever. So if it's never changed in Forex, they really don't care about crypto and its tiny little market cap. It's because of our very small market cap that it's very, very easy for the market maker to take this Forex business model and apply it to cryptocurrency, and essentially just do the same thing to us that they've been doing in the financial markets for decades. So in conclusion, if you have ever been taken out by a stop hunt and then the trade went your way, or if you've ever tried to take a breakout trade and it didn't come back for a retest, if you've ever entered a trade with a crappy risk reward because you thought it would just keep going and never come back, know that it is all by design, and the market maker triggered your emotions to get you to do that, because they can't take your money unless you commit to a position. But like I said, having this knowledge is power, because the next time you feel yourself at risk of doing one of these things, you're now going to be able to stop yourself and say, what are they trying to get me to do right now? The goal now is simply to get smarter and to be able to see this happening in advance. That's why heat maps and liquidation data and things like that are all tools that allow us to see this ahead of time. Earlier, I mentioned to you that the market maker doesn't just get to roam free doing whatever they want, and that they have limitations placed on them by the IMF and the World Bank. They have other limitations too that we should be aware of, so let's go through that now. Number one, of course, the target is placed on them by the IMF and the World Bank. They set the targets for the market maker and the deadlines. The deadlines are by market close at the end of the week, monthly, and seasonal. What the market maker does between these targets is up to them, but come the deadline, the price needs to be where they have been told it needs to be. So for example, let's just say we open the week with Bitcoin at $20,000, and the market maker is instructed to close the week at $15,000. Before the week closes, the market maker could send price all the way up to $25,000 if they wanted to, as long as come Friday, 5 p.m. New York, they have brought it back to $15,000. And this is why we have the midweek reversal. Hopefully you watched the One Formation We Trade video and understand the concept of the midweek reversal. If not, be sure to do that. It's located as one of the first videos in the Masterclass course on the website, or the second last video in the Zero to Crypto course, also on the website. As mentioned earlier, if the market maker didn't have these restrictions, they could literally collapse the economy with the amount of capital they have. So it's best that the IMF does that for us instead. The second limitation is equity. The market maker does not have unlimited equity. At some point, they have to get back their money. As I mentioned earlier, when you as a retail trader open a leverage position, you are borrowing funds outside of your margin from the market maker. There's only so much they can lend out before they have to take it all back. As retail traders, we can't know what this limit is. However, as someone who has studied liquidation charts for years now, I can tell you that generally around the $20 billion delta on a liquidation chart is close to the limit before they usually will turn price around. If that sentence made 0 sense to you, that's normal, don't stress, it will be covered in this course. The third limitation is that they are limited by weekly net change allowances. A couple times in a month they can go wild, but they must bring it back under control. They can push it past the limit, then they have to bring it back in line by the deadline. Otherwise, currency gets devalued and crypto is the same. Finally, market makers have seasonal targets and weekly ranges that they're given. We'll go through their trading times in detail, but basically they start their session at 5 p.m. New York. Between 5 to 8 p.m. New York, nothing happens because that's when they're being given their orders for the week. Price can be manipulated during this time by whales and bots, and it often is, because if the market maker is off duty, the volume is lower, and if the volume is lower, it's easier to manipulate the market because you need less capital to do it. But the market maker will bring price back where they want. In the Asia session, don't doubt it. The market makers literally just pass the rules to each other from Asia to the UK, UK passes to US passes back to Asia, and it just keeps going around in that circle. The goal for them is to make money, but they have to be aware of the economy, otherwise they can destroy it. They're given a price point on Sunday open. They're given a weekly net change. They can run it however they like, but they must bring it back to that weekly net change by Friday. This is why we get the weekend trap on Fridays. Again, covered in the one formation video, but it will also be explained in detail in this course.